Why was the gold standard blamed for the Great Depression? Imagine a world where countries are tied to a fixed amount of gold, unable to change their money supply easily. That's what the gold standard was. During the late 1920s and early 1930s, this system was blamed for making the economic downturn worse. Countries had to keep their currencies at a set value in gold, which limited their ability to respond to economic problems. When the economy started to slow down, governments couldn't just print more money to help. Instead, they had to stick to their gold commitments, which meant raising interest rates and cutting spending. This made the economy shrink even more, causing prices to fall and debts to become harder to pay. Many countries, including Britain and the United States, tried to go back to the gold standard after World War I. They set their currency values based on pre-war gold prices, even if their economies had changed. This overvaluation made their exports more expensive and less competitive abroad. As a result, trade deficits grew and unemployment rose. To defend their gold reserves, central banks increased interest rates, which further slowed down economic activity. As prices kept falling, debts became more burdensome because they stayed the same while incomes shrank. Banks failed, and financial panic spread across borders. Countries that stayed on the gold standard longer, like Germany and France, suffered longer and deeper recessions. Those that left earlier, such as Britain in 1931, could devalue their currencies, making exports cheaper and helping their economies recover faster. The gold standard also limited how governments could respond to banking crises. When banks failed or people rushed to withdraw their money, governments couldn't easily increase the money supply or lower interest rates. This inability to act quickly worsened the economic collapse. The system's rigidity meant that countries were locked into policies that deepened the downturn instead of helping to recover. In the end, many experts blamed the gold standard for spreading the economic pain worldwide. It kept countries from adjusting their money supplies during a time when flexibility was desperately needed. The experience showed that a fixed gold system could become a trap, making economic crises worse instead of better. This led to a shift toward more flexible monetary policies and the eventual abandonment of the gold standard.